Welcome back to our economic data series where we're going through all the releases you see in the monthly cycle to explain what they are and how they relate to each other, to better help you understand and deal with them in the markets. This week we're taking a look at another relatively smaller release that isn't given as many newspaper column inches as other major releases, but is still quite important. It's the NFIB Business Optimism Index. And just before we get into that, if you do find this series helpful and enjoyable, please do hit the thumbs up button. It helps us to get discovered by more traders and investors like you. And if you are new around here, then make sure you subscribe so you don't miss the future episodes. So let's get started. The NFIB Business Optimism Index is a monthly release that focuses on smaller businesses across the US. The NFIB is an organization that has hundreds of thousands of small US businesses as members, and some of these members provide the information that the data for the index is compiled from. So the NFIB index uses 100 as its baseline number for the headline release, and above this level of 100 shows optimism, and below the level of 100 shows pessimism. The headline figure is a non-weighted index based on 10 survey measures, which you can see on screen now, and the data can be used to predict changes in quarterly GDP, the labour market, and inflation. So typically, if the index falls to around 95 to 90, this could be a sign that a recession is on the horizon as businesses are feeling particularly pessimistic. Individually, a single or a few businesses with a pessimistic outlook is not really going to make much difference to economic growth. However, if lots of businesses across the US are pessimistic at the same time, this could create a noticeable drag on economic growth. This is because the more optimistic a business is, the more likely they are to invest in expansion and create more jobs, and the less optimistic or more pessimistic they are, the more likely they are to put their plans on hold, which could also include hiring. So, for example, just prior to the 2008 financial crisis, the index fell to 94 and then below 90 in the two following years. And during this period, approximately 170,000 small businesses were forced to close down. NFIB members are small-sized companies, so each one in isolation may not seem that important for the economy, but small businesses like these ones account for around half of all US payrolls and 44% of economic activity. So this means as a collective, they are pretty important for the US economy. Now, one of the big concerns is that during economic downturns, smaller companies tend to have a much harder time compared to larger or multinational companies. This is because they simply don't have the same access to resources like capital and infrastructure. And depending on the state, they may also be negatively affected by state and local laws, which may have less of an impact on companies that operate across many states or overseas. So, since they have fewer options to access capital, the Federal Reserve will want to be paying attention to how small businesses are doing, and they may not want to tighten monetary policy too quickly if small businesses are in a cash crunch, for example. The index also helps officials to identify problems that businesses are facing and where they stand on things like prices and regulatory issues. For example, if many businesses are looking to increase output prices or input prices are on the rise, that could be an early sign of inflation. Another example could be that if businesses are struggling to find workers and vacancies remain high, they may need to increase wages to attract more workers, which will ultimately feed through into inflation. Labour shortages also reduce the ability of businesses to expand, which will again hold back economic growth. Since small businesses also have a flatter structure compared to large organisations, they can also usually change course much quicker than their bigger counterparts can. That means we can get information quicker on the expected direction of the economy relative to surveys of big businesses, for example. So now that you know all about the NFIB Business Optimism Index, next, why not check out previous episodes on the Philly Fed Manufacturing Business Outlook Survey, which is up here, or the Producer Price Index, which is down here. And don't forget, hit the like button if you're liking this series so far and finding it helpful. Thanks so much for watching. I'll see you in the next one.